Hello, everyone. My name is Doug Garber with Pitch the PM, and we're going to do a webinar today on NVIDIA. So everyone should have the ability to send questions in via chat, and you should be able to follow along with the deck. The deck will also we'll send a link in the chat for everyone to follow along outside of the webinar and to have. So please click through the deck as well for your reference. And if you have any questions, just put it in the chat and we'll be able to respond throughout this. We want to make this interactive, and just hit me up with questions as we go and I'll answer them. So our sponsors today are InSync Analytics. They do a lot of my custom modeling, and also FinTool. They're this great AI that makes the whole research process super efficient. It's a really efficient way to get all of the the research done quickly. I'll go through some examples of how I use that. So NVIDIA, it's about $108 stock today, about a 2.4 billion market cap. EV is about the same. I want to start by just going over kind of everyone has some place that they're starting from, and they have a bias and their credibility. I'll give my quick background. Right now, I'm at Westport Alpha, and I'm the CIO, and we kind of do special projects and specially managed accounts. I was at Millennium under Katahdin Capital, running a long-short multi-strat tight ADO, and then before that I was at Citadel Surveyor Capital. So originally I did energy, then industrial. We did some capital markets, utilities, and then actually I also did investor relations at Fiverr in the tech industry. So I haven't done semiconductors before. I have been researching this for a while. So NVIDIA is, everyone 6-7% of the S&P. Retail weight, we did some posts on that. It was closer to 10%. And one of the things I want to point out here is, the winners or success bias is real. When people are doing well, I think they'll continue to do well. And with me, I have not owned this stock before. I didn't benefit from the 6 or 7 bagger, but I did start to look at it last year. Kind of thought things were a little ahead of themselves, a little bit of a hype, and I started to do research over the last 9 months. I do want to disclose that I do have a short position. It's been about 15 to 25% of my portfolio on the equity side, short varying over the last kind of 6 to 9 months. I built up the position as I've done more work. And actually last week I did sell some puts. I layered them in from 80 to 90 to generate a little bit of income. And just because I thought the stock got really sold off pretty hard. Again, this is not investment advice. I'm not your financial advisor. So do your own work and make sure anything you do is suitable for your risk tolerance and options and all that. I also want to talk about, NVIDIA. I think one of the interesting things when I went to investor relations, I think everyone should do IR for at least a year. If you're going to be an investor, you talk to them all the time and just understanding that whole process of how they communicate information and collect it. It was super enlightening. So obviously Jensen and NVIDIA, super high credibility, but they're also biased. And so are all management teams to promote their own stock. So I tend to look at companies' actions more than their messaging, as someone who's actually created messaging for companies going through a cycle. So Jensen, he's 62. He's a founder of NVIDIA. He's done absolutely an amazing job. He's a billionaire. Everyone kind of, whatever he says is essentially gold. He's had so much success. People are going to believe him. He owns probably 97 billion of NVIDIA shares. Their IR team's obviously done a great job continuing to talk about the AI revolution, message up the bigger TAM, the scope, rebuffing the narrative. I always have a very big professional team there on both the communications and PR team or IR team. I do look at his actions. He has sold about 78 million shares. That's worth about 8.8 billion at about $113 yesterday. We kind of priced everything, since 2023. Now those were shares he was kind of awarded, but his total net shares has still come down a little bit over that time. But he has done absolutely an amazing job, right? He bet big on GPUs, on creating the GPU. Then he added the software and the CUDA to create the barrier to entry, and he also added the networking. So he really now dominates the data center. So, and he gets a lot of credit. That's why I want to, most of the time when you're investing, a lot of people give a lot of credit to what management is saying, and especially this one when you have the whole media kind of parroting what management's saying. That slide. Our process, we do have a 10-step variant view process. This is the process I used and was trained on at Citadel Millennium. I've tweaked it over the years and adjusted it into my own process, but it's kind of been something that people kind of customize for themselves. So the first question is, what do you want your PM to do? And everyone has a different time horizon and different vantage point and different things they're coming from. So I obviously have more of a cyclical background and that's more of my mental model. So the first question is, what do you want your PM to do? For me, I'm negative the stock. And obviously everyone on Wall Street is positive. It's 90% buy ratings. So do I understand the business, semiconductors and GPUs? I don't have 10 years of experience here. I will say I've spent a lot of time researching this, and I do see some similarities in what's going on in this cycle to previous cycles in my mental model. And what got my interest was the talk of the arms race. So I started to dig in, peel back the onion, and kind of see what are the customer economics, what's really going on here. But my mental model is a cyclical model, not a secular model. And some other people are more secular. So, we have different vantage points, and that's okay. And I've also seen cycles, a bunch of different cycles, whether it's energy, industrial, or even more recently during COVID in the tech world, people go from growing 50 to 80% to all of a sudden the market says, all right, that's great, but now I want to see free cash flow and returns as growth slows. And that's more for the NVIDIA customers. I think we're going to at some point go through that transition where it's growth at any cost. And then all of a sudden, hey, hold on, where's the free cash? Where's the returns? And all the customers we'll go through it later. The big four hyperscalers at least have seen less, free cash flow. And I'm not sure they're even getting a return on capital, not necessarily the big four, but like some of the other neo cloud guys. So, if you want to discredit me, you could argue, hey, Doug doesn't know what he's doing in semiconductors. It's out of my circle of competence. Yeah, I mean, that's fine. Everyone has their different vantage points and, pros and cons to any investment, and they bring with them their history. I tend to think of things, and I'm going to quote Howard Marks here. He says, I think it's essential to remember that just about everything is cyclical. There's little I'm certain of, but these things are true. So whenever someone says secular or TAM or use case, I'm like, all right, that's kind of, it's a hype. So I did go through my research process. I have my 10-step variant view process we'll go through. I focus on supply and demand of GPUs and measuring that as best as I can. And at the end of the day, the leading edge price is really what will tell you what the supply and demand is. And then I also look at the supply and demand of NVIDIA stock, which is different than the GPUs and the earnings, but who's the next buyer? Who you selling to? And I put up some posts before on kind of going through hedge funds, long onlys, retail, and we kind of said, oh man, there's 2-3x levered ETFs here on retail, and retail's overweight this, and hedge funds have sold it. So that was also a little bit of a concern. So here's the 10-step variant view process that I go through. We'll go through it again at the end and see where things check off. I've done 4 other episodes on YouTube, so feel free to go look at those, and this is the process I use. So the next, I'm going to actually start a little bit out of order here. We're going to go with question 8 on what is it worth if my bet is right? So I'm going to start with the bear case and the bull case at the very start of this, just so everyone can kind of have a balanced view. I mean, I'm essentially going to explain how I think about the stock, what evidence I gathered, and present both cases, the bear case and the bull case. I just want everyone to kind of know, what is my bias going into it, right? To go to talk to a management team, it's kind of, they feel like it's their job most of the time to sell you their stock, or they own it, they want you to buy it. So street expectations are too high. The street essentially has quarter-over-quarter revenue growth of $4 billion a quarter, last year and this year, and I think that could be a high bar with Microsoft and Amazon flattening out their CapEx sequentially. Other people will have to step up, and then there's decline in revenue growth. It's still growing, but it's decelerating, and that in itself could be a bear argument. And then you're seeing China is 30% plus of the revenue. And, you saw the big move yesterday on the restrictions and the taxes there. So that's a big chunk of exposure that's kind of out of our control based on what politics decides, or at some point China will, increase their own competition of chips. And then I went through the customers, and I'm not really convinced there's a compelling ROI from AI for the people who are buying all these chips. So people are doing a little more speculating than kind of a cash on cash value return. Supply, the competition is rampant. Great returns. People come in. I don't think this is anything super new. I mean, people know Amazon's had chips. They're starting to roll out their own kind of advanced chips in Q4, sell external use. Google, same thing. They're on like their 6th gen chips, and then their TPUs. They're starting to ramp up their own production. They're starting to rent them out to external customers. And Microsoft's a little bit further behind, but they are also doing their own chip projects, and they are available, I think, for rent. I'm not sure they've been mostly internal, but they're it takes a while. It's many years of R&D to kind of iterate, and that's why NVIDIA is the best, and so far they're continuing to be at the leading edge and be the best. You have the Chinese, they're ramping production. I've heard they're only a year behind, and they're going to have a lot, not as good chips, but a lot cheaper chips that should do the trick. And then you obviously have the efficient models like DeepSeek, and people just need less compute to do the same thing. You've seen Tencent and Alibaba in China say, hey, we need less GPUs because we're more efficient with the models. Caveat to the supply piece of it. Longer term, I mean, GPUs are big in Bitcoin. It's about 25% of GPU demand. Obviously, that's outside of China. And Bitcoin's kind of been accepted at this point. I'm not really in that camp. I kind of tend to go with what Buffett says is, companies aren't using it. I think it's worthless, but that is nothing in the near term. But maybe, the next 4 years and whatnot, we'll see what the usefulness is of Bitcoin and the GPU demand there. And then, AI could be on devices if it gets really efficient, not data centers long term. There's quantum out there. And then he kind of put some numbers around it, the low on the street for, call it fiscal year 27, calendar year 26, essentially. It was the DA Davidson Gill. We did an episode. You should definitely check it out on YouTube. He's at about, a little over $4 of earnings. He's low on the street. You put a 15, 20 multiple on that, and you're going to get about 60 to 80 bucks. And I call that the bear scenario. The multiple will depend on how cyclical people view the industry, if they view it as a peak or a slowing. So that's kind of the worst case if you want to put numbers on it there. But, that is 30 or, $30 to $45 of downside. And that's the thing with NVIDIA. You do have high risk, high reward. They call it 50 bucks of downside and also 50 bucks of upside to call it the consensus target. So that's a lot of value either way. So I do want to talk about the bull case, right? More bulls than not on this name. Obviously, there's the TAM. There's the $1 trillion TAM, and that's probably growing as they could kind of message and define it. And it's replacing all the data centers with GPUs and high grading those. The thought is with TAM is that continue to be a 20% plus grower as long as you have TAM left to grow into. And for this, I'm not a big fan of TAM. I've seen people have TAM and then all of a sudden the growth stops and they're like, all right, what about the TAM? So I've kind of saw that in the last cycle, at least in tech with these COVID guys growing 40, 50, 80%. And then all of a sudden they just pulled demand forward and, they have this big TAM, but what happened to it? So I'm a little skeptical of TAM. Big tech needs to keep increasing CapEx. We obviously had huge revisions into the last 6 months, and people look at it year over year. You need new customers to continue to come in because some of big tech has been, at least they were big numbers year over year, but sequentially they're slowing. We'll get to that later. Demand, obviously, the post-training versus the pre-training, Jensen's talked about being 100 times more compute intensive than pre-training. So that's big. And then obviously TAM could grow with more use cases, whether we're talking about cars or robots or all sorts of stuff. People could argue, hey, we're just in the very early innings and kind of paint that picture. I tend to go for more what's the evidence on the supply and demand. I look at it as one of the bear cases is the street's just ahead of themselves. It's not like it is still a great company, has high margins, 30% EBIT, 25% net income, very strong ROI, right? 58% ROIC, 26% ROA, and they're ahead of everyone. They have the best chips, they're more efficient, they're going to produce more tokens. So all that is true. I think it's just a rate of change and expectation story is more of the bear case. It's not that NVIDIA doesn't have the best product. They do, and they have a great company with a lot of great free cash, and they're going to continue to make money. I just think there's going to be some competition and there's going to be a little pressure to margins and really it's just that expectations are hockey sticked out there. So, right now we're still in a shortage position and the bull case is NVIDIA continues to iterate ahead of everyone else and maintain that leadership position. They continue to have their barriers to entry with their CUDA software. And they also have, the whole networking system out there as well. But, there are the software, people have figured things out. Obviously DeepSeek and their competitors have big pockets to figure out the software as well. People like, it's large companies, it's Google, Microsoft, they've got some strong software skills. So it also, the interesting thing is now, it's at historically low multiples versus its own history. You're talking about, PEs 21, 22 times versus historically being 30, 40 times. So there's some of this negativity that's already being priced in. A lot of these risks, this news is on TV now. So people are aware that, Microsoft's cutting leases. And so the bar has been lowered for sure. And that's what the multiple is telling us that's priced in. They don't necessarily, it's essentially that it's a little bit easier of expectations now. So that's kind of what the lower multiple tells me. The valuation for the bull case, let's look at consensus, right? It's a $170 target. It's essentially, 30 times PE on, call it 2026 calendar year, 27 fiscal year numbers. That's, a little over 60 bucks of upside. So that's the math there. That is reasonable as long as they can hit those numbers and people believe that it's still worth 30 times because they're still growing 20 to 30%. So those are the two cases. Continuing just kind of a quick overview. I know a lot of people on this call, some are super experts, some are a little bit more generalists. NVIDIA, the gold standard for GPU chip supply, 100%. got essentially 90% share, 70, 80% share if you talk about what, some of the hyperscalers use internally. They use some of their own stuff. You got the software, the network, and they're the complete package. There's AMD. They're kind of the number two. They don't really have the software around it. They've got some share. There's the Chinese, which have been ramping, right? I would say that's 30% of NVIDIA's demand, but they're making do with tier two chips essentially. So I've heard they're about approximately a year behind. They're not the fastest chips, but I heard they are going to be a lot cheaper. So you can still get enough bang for your buck. We'll talk more about that later. And they will also dump into certain countries. I've heard that's already going on in Ukraine, Israel, etc. A lot of my approach is to go down. What's the thing about NVIDIA is about 4 customers are half the revenue. So that you can kind of just go, what is their behavior? And go for it from there. So Amazon, they make their own chips, and they have enterprise. They're a cloud provider as well. They've been making their own chips for a long time, probably 10 years. But recently in Q4 on the GPU side, they've started to rent out not just the NVIDIA chips, but they're offering their customers their own internal chips. And they've had a lot of good feedback. These are big customers: Databricks, Adobe, Anthropic, Qualcomm. So that just kind of started, call it Q4 of last year. Google, same thing. Obviously, they're more internal use for their own use, but they do have enterprise cloud, and they also have the TPU, which is they've been ramping up production. They started to have Apple train on that in July of 24, and then other people in Q4 started to use it. Wayfair, Snap, LGAI, and Citadel as well. So that their competition has kind of just started in terms of, hey, you can rent both chips and different benefits for different purposes. Microsoft, they're a little further behind. They're mostly internal use. Obviously, they do have the enterprise cloud. They are more of what I would call a nascent semi-producer. They just kind of rolling out this Maya chip. It's available. I haven't really heard of a lot of people using it yet, except for internally. Microsoft, we'll talk about it later, but they are also scaling back their data centers. I've heard a lot of news about that. I've also heard some chatter from people I talked to that some other people just took them up. So, and it also could be that they're letting go of some of they kind of did a land grab. They didn't need all the sites, but they're still going to spend more on, call it the revenue producing stuff, the GPUs, the CPUs. And then there's other people entering. Cerberus, there's a nice YouTube CEO interview there, and they're specifically designing their chips for inference, and they're claiming theirs are more efficient. So there is competition coming out there. So more on, do I understand the business? Part of the negative variant view is that expectations are just really high. You can see a quarterly revenue like it's just hockey stick expectations, and it's the growth is supposed to continue. You also kind of look in here, there's a little bit of cyclicality as well, at least historically, and you've seen that in the other chip. It's still going to grow over time, but there's going to be cycles here and there, or a little flat spot of supply and demand imbalances the other way. So I think that's important, just to also have that background of the revenue. I think everyone knows, they've been growing fast. So part of, like I said, it's they have record growth expected. It's a high bar to beat. What I'm looking at here is kind of the growth to get from, call it 60 billion to 240 billion. And you're going to see that the street expects NVIDIA to do it in 4 years, right? It took Apple once they got to 60 billion, it took them 5 years to get to 300. It took Amazon 7 years once they got to 60 to get to that 300 level, or I guess 8 years is what I wrote here. So the slope is what is really one of the concerns for NVIDIA. And all right, so how did I go about this research? I'm going to kind of skip ahead a little bit here to kind of section 6 of what is my evidence. So when I was researching this, I did use FinTool, and it identified, I just put in a quick search, $Google, who uses Google TPUs. This is so much more efficient than having to read all of the transcripts, and it also dug up some other stuff. So you see companies like LGAI is using it, and it's helping their processing speed. Then it also pulled up things not just from the Google earnings transcript, but it also pulled up things from other companies' investor days. Like I never would have found that this biotech subsidiary Instanet, that they're using it for their reinforcement learning, and they're getting call it 13 times cost reductions, and it's like 240 times faster. So I just thought that was amazing that I was able to pull stuff that I wouldn't have even thought to pull up and Control F and go to the website. So it found stuff, it got it to me really efficiently. And then it also found stuff here, you look at this last one, and there was like, hey, it just indicates significant growth for Google TPUs. So I'm like, all right, where's that coming from? So I clicked that press release, and it gave me, an analyst here, and he's kind of saying, This is a press release from a public company, but the TPUs, or Google is essentially ramping up their own supply. And not only are the people using them, but they're going to produce more for their own internal use, and that means they could rent out both NVIDIA's chips and their own chips. And so that was an interesting anecdote that I wouldn't have even thought to look for, because I kind of said, all right, I'm going to read all the transcripts of the major customers, everyone from Oracle to Amazon, but this pulled in a lot of other stuff, and it did it super efficiently. It probably did it in 25% of the time that I would have done it if I wasn't using FinTool. So if you're not familiar with FinTool, it is it's an AI tool. It's a search chat. It's ChatGPT plus Edgar. It'll improve your research efficiency. And it's tailored for institutions. They leverage large language models, so they kind of put an infrastructure layer in. So they have this language model, and they put in a layer above it, so that they're able to get the data kind of in that layer. So it really is just so much better than just pure kind of ChatGPT. So try it out, this free trial, FinTool. And if you use this link, we'll get it supports us at Pitch the PM and all this work that we do, that we kind of give out, because we love doing research and sharing, the convictions and our process with everyone. So I'd appreciate it if you want to click this link right here and support us, and you'll enjoy the trial. And I think we do have a question here. So let me see here. All right, we're going to come back to these questions at the end. And the evidence, so again, just going back to the supply side. So I'm a little bit more bearish, so I'm spending more time on the supply than the demand. Demand's also harder to measure, but this is again from that D.A. Davidson call with Gil Luria that we did. We did a whole episode, hour 20 minutes on YouTube, but we're just talking about where are the Google chips deployed, how in their regions, where the Amazon chips. Amazon's a lot more fully deployed, doing some, and then Maya or Microsoft is not really out there as much. This was as of September of 24. So these guys are going to start putting their own chips in their data centers. Now, there's the whole data center market where there's a lot of other people out there who will buy NVIDIA's chips. You've obviously seen the CoreWeave IPO, and there's a few others out there. But actually, there's a lot of others out there that could, upgrade to the GPU. So you kind of have the cloud area, which is the main hyperscalers, but now you have all these GPU data centers. So there's going to be a lot more competition on the data center side. On the Chinese side, I was talking to one of my friends, Jeffrey Emmanuel, and he kind of said, and I'll just read you the quote, the Ascend chip, which is the Huawei chip. And he says, listen, it's slower and less power efficient, but it's priced so cheaply that you get enough bang for the buck that it's around 50%. Your bang for your buck is 50% higher than a H100. So it's typical Chinese. They're not the best, they're not the most power efficient, but it's cheap enough that if you have enough of them, it does the job cheaper. And we talked about some of the some of the technical stuff on kind of flops and stuff here, where you see that they're really making good way from that perspective as well. So that's just the competition coming in from the cheap side. So there's kind of two things, on the two ways to do better with the chips. One is have the better chips and make a better frontier model. And the other way is to make your training models more efficient. So this can help, at least on the latter. So the main reason I wanted to kind of do this webinar is all right, you have a bull case, you have a bear case. There's truths in both. What is priced in, and what does the evidence say? So if you look at just kind of a quick 5-year chart, I know whenever you pitch a stock, someone wants to pull up the chart. So you saw the stock obviously go from, call it, $18 all the way to 150. Now it pulled back to close to 100, and now it's probably like 110, 105 today. And we'll talk about how that actually was somewhat reasonable. Here's the chart of the stock. When you look at it on the next slide, and you're looking at the historical PE, it is cheap. You're almost at the lows here, at 21 times on a 10-year next 12-month PE, and the average is 36. So there's definitely more negativity priced into the stock, or people are perhaps not quite expecting negative earnings revisions. I know that part of this negativity was around the tariffs, which would have had an impact on them. It seemed like that's getting bypassed for now, but there's still competition coming in there, and there's still some issues there. And then, I always look at not just earnings, but price to free cash flow. It's kind of always on my checklist, but in this case, it's a very similar story there. The earnings and the free cash, essentially the same conversion. It tells the same story. It's at 27 times price to free cash flow. The average is 38. And then I also look at EV/EBITDA as well. And again, similar story. You're really cheap at least historically, or 18 times versus an average of 27 over the last 10 years. So all these historical multiples are telling you the stock's historically cheap. Now, one of the important things to know, if you think that's on a secular basis, if you have the cyclical mindset, it's a different mental model. And when I say that, it's one of the things that got me into when I noticed in my research is, the last 3 quarters, the stocks had beat and raises, but the stock didn't go up. Now, when a stock gets close to the top, it's kind of a peakish sign that you're beaten and raising and the market doesn't care. There's no follow through. And also, if you get to a super cyclical business, you see lower multiples at the top because the market knows that that's kind of the peak margin and you're going to have negative revisions from there. So it's actually, if it is a cyclical, that's actually a signpost that you're at the top. And I think this one of the big debates is the cyclical or secular, and it has some attributes of both. I think it is cyclical within a very good industry with good returns. Also look at it relative to the market. It's only at 1.1 times the market. That's sold off a lot. But again, the market, it's never really been this cheap. Historically, it's been 1.5, 2 times, up to 3 times the relative PE to the market. So now it's essentially at parity with the market, a little bit above, large cap company, growth industry, great returns, great free cash flow, no debt, and lead an industry position. So that is attractive to some people. Again, my view is there's competition coming and the revisions don't matter. It's more of a cyclical, and that's why the lower multiple isn't attractive enough for me. But I have a different background and different vantage point that I bring to this based on my history versus other people who might be in the VC or the tech growth world. So the next question, number 4, why is the stock mispriced? I think people are buying into the TAM GPU thesis, and AI is kind of a hyped market currently. You've heard a lot of people talk about bubble. I mean, NVIDIA itself is obviously not in bubble territory with this sort of valuation. They have earnings support, but I don't think their customers do. I think there's a lot of money funding their customers to buy GPUs or to fund AI research that is a little bit more speculative and isn't really supported by cash on cash returns. Now, some of those projects will turn out great. Some people will get a great return. It's just the ones who improve their return on capital by deploying AI. So overall, I kind of say, well, earnings revisions are the main driver. And if you look historically, the stock has gone up, call it 7 times, 7x, but it's also earnings have gone up a similar amount. So it's actually logical, in my opinion, the move in the stock over the last 2 years. I think AI, one of the things that got me interested in it on the negative side was this, hey, everyone's calling it an arms race. To me, that's a red flag. That means people are spending without having a strong return on it. They're more speculating, and people are hoarding chips too. There were people buying them just because they could get them, and that was also going on. So that also tells me that we're a little bit of hot air in the system. And then I think people have bought into this TAM, and not only the TAM market, but like use cases, which is a whole nother. It's like we can't even define the TAM. We're just going to use the word use case, and it's worked. So that's just people get more bullish. Those to me are more not things I can quantify. I'm not a big fan of those arguments. I tend to have more of a, call it, value bent. And then I think it's mispriced because not everyone, but people tend to think early innings, it's secular. I tend to think it's more cyclical. I think there's attributes of both. So here we just see the earnings revisions. You kind of see over the last 2 years, earnings are up 7.6. This is the revision for 2 years out is up 7.6%. The stock's up about 6.3. So the multiple, it was at one point about equal, but it's pulled back. So you see it, at $137, then it's at the 7.6. So there's been a little bit of multiple contraction. Again, last quarter, earnings were revised up about 1.2%, but NVIDIA was down 8.5%. To me, that's peakish stock behavior. Some people might say, hey, that's an opportunity. The stock's not reacting, but I have, again, a cyclical mentality versus secular one. And the other reason I think the stock's mispriced is, messaging. I mean, you're trying to paint, any companies can try and paint a bullish picture, try and outline their TAM and talk about how we're in the early innings and talk about the story more than the numbers. And numbers have been good here. They continue to beat and execute. So they talk about, they're painting the picture of percent of world GDP and talking about the early innings. And this is what Jensen said on his last conference call. So they're doing a great job messaging and continuing to paint that picture that people want to buy in. And to some extent, they are right that we are early innings in AI. I just think expectations, again, are too high and there's competition coming. Margins are probably peaky because they were right place, right time. They were early and they've got the lead. So more about, what is my next step? Question 5 is, what is my variant view versus the street? The main thing is that customer returns do not appear supportive of all the spending. So how do I measure that? So we'll get into that a little bit later. The other one is the street is mismodeling the revenue. They're using kind of the trend as my friend, and we grew by $4 billion a quarter. We're going to continue to do that. And then I'm seeing large customers actually, they're growing year over year, but on a sequential basis, it's starting to flatten out. So for things to work, you're going to need other customers to step up, and maybe that'll happen. In my variant view is obviously I have the cyclical versus secular vantage point in my process. And, you're also seeing, like I said, this competition, Google, Amazon, Microsoft, China, they're all ramping up production that wasn't here for the last couple of years at this high level in the GPU space. And, the CapEx, like I said, it's more arms racy and not really supported by the ROI. And then, to measure the supply and demand coming together, we look at the rental prices, and those have been softening. And I've also said, hey, the public company returns, you can now look at, there's kind of two public companies here that rent out just the GPUs. They're not bundled in a mega cap, and those returns don't really add up to me. They look softish or suspect, but I know you have to kind of dig in a little more. I've also done some channel checks and expert call network things where I've said, hey, people have said, hey, the H100 returns are not there. So you gotta read the whole transcript and stuff to kind of really dig that out. So. And then the last thing is, whenever people are making kind of a TAM argument, that's just not for me. TAM is, what I would call a bullshit argument in value investing. I know some people call EBITDA kind of bullshit earnings. TAM's bullshit, the bullshit thesis. And use cases are even worse. But use cases are like, we can't even define TAM. We're just going to call it a use case. And there's been a lot of that with NVIDIA. And there will be use cases, and those are out there. I'm just not sure I want to pay for that. I want to kind of pay for a reasonable thing and get those for free as they're proved out. You don't want to pay for things that are just an idea. So the variant view, obviously the street, the sell side at least, is super bullish. 90% buy rate and 0 sells. That's out of 69 analysts. This is just one part of the street. This is the sell side. And sometimes the sell side, it's a different vantage point. They might only cover semiconductors. So this is the best semiconductors. We'll have, they're going to win relative to everyone else. Sometimes they're just other motivations sometimes, or it's worked and you don't want to go against the grain. There are obviously other opinions out there, on the buy side or hedge funds that maybe aren't as bullish as the sell side out there. So the evidence, what is my evidence? This is an important section to me. This is a lot where I use FinTool to kind of do the chats. So it's just the customer returns don't appear supportive. We talked about this at the episode with Gil Loria on YouTube, and the Microsoft specifically. Their ROIC starts to decline from 21 to 20% in 2024. You kind of see that chart over there. They've been spending a lot on CapEx, and that's one of the reasons. And the CapEx is for data centers and such. CoreWeave, they just did a IPO. You're looking through their S1. They've had not a lot of history actually, because it just kind of ramped up, and the returns are weak. If you look at the traditional, not even ROA, but even an EBIT instead of a net income over average assets, you get, call it, last year was 324 of EBIT over an average of 11.2. That's a 3% pre-tax ROA. You want to look at it another way. You get, just annualize the back half of 24, you get 460 million of EBIT. And then you take the current PP&E of 11.9, you get 3.9%, again, pre-tax. So either way, those aren't great returns that are going to justify a lot of spending. And they are, I listen to their roadshow, they are expecting better returns going forward because they're expecting the software to improve their returns. A lot of it is because they spend a lot, on NVIDIA chips, and NVIDIA has 75% gross margin. So they're essentially taking the rent and the returns as kind of going to NVIDIA. And that IPO was not really well received. They had to downsize it, I think, to 1.25 billion from 4 billion. And there could be a funding gap now on that potentially if they had a big CapEx plan. If they don't reduce CapEx, they were expecting a couple billion more to help fund things. I'm sure they can flex that with the or get capital from other sources. There's another public company, Nebius. You just looked at FactSet real quick for their ROAs. The last 4 years, it's 0.2%. -6 in 24, 3% in 23, 7.5 in 22, and -3 in 21. I guess I'd really look at the 23 and 24 one. That's really when the GPU cycle that's been really good pricing too, right? That's pricing kind of spiked and it's kind of come down a little bit. So they're not getting a great return on capital either. They don't even, I did ROA just to neutralize the capital structure. And if you just look at the CoreWeave, the straight ROA without taking out the noise, you'll get like -7% if you just pull up the straight calculation from the financials without doing adjusted numbers. So that coupled with the channel checks on the expert network calls saying the returns aren't great kind of makes me suspect this is a little bubbly. So the evidence, again, NVIDIA's consensus quarter-over-quarter revenue growth, last 7 quarters, they've grown by 4.6 billion per quarter sequentially. And then the street model is 4.8 billion of growth per quarter sequentially for the next 4 quarters. They're just kind of doing, the trend is my friend model, and I've done it. It's what they've done. We'll kind of continue to do it. There's not much else to go on. And I never really understood, NVIDIA only guides 1 quarter out. And it's interesting because their customers give full year CapEx guide, and even other data center companies on the industrial space like Vertiv, they give a full year guide. So I don't know why they only have a quarter visibility. It's just a little odd to me looking at NVIDIA. So the top 4 customer, the growth has been decelerating, right? This is their CapEx for these 4 players. Obviously the headline number was big and it was revised up over the last 6 months by, call it 28%. 57% growth in 24, a lot of media headlines. 25, the numbers that were just announced, is going to be 34% growth, which is great year over year. Sequentially, in 24, it averaged a 14% growth per quarter. In 25, it's only going to average 3% growth per quarter. So they're kind of pretty close to that run rate that they're going to be at in 25 by the 4th quarter. There's still some growth, especially from Google and Meta, but Amazon, Microsoft are flattening out. And that alone is sometimes a bear case, is decelerating growth. Now, the CapEx it's not one for one. Obviously, there's a huge CapEx budget, and not all of that goes to NVIDIA. There's definitely mix issues and moving parts within that. And then also NVIDIA has other people to sell to other than these 4, since the market is still short. But again, just growth that's decelerating, that alone could be a bear case. So moving on to the next slide, just talking about big tech, kind of the big 4 here, Amazon, Google, Meta, Microsoft. They've ramped CapEx a lot, and this has tremendously benefited NVIDIA. So the top 4 customers, CapEx percent of NVIDIA's revenue, first quarter 23 was about 20%, and now it's about 60%, and is forecast to go to 80% in 2026. So again, not every dollar of CapEx goes to NVIDIA, but definitely they're taking a bigger percentage of it as they've been growing. And then the big 4 have just grown tremendously. If you look at the chart on the left, they were doing the first half of 23, about 32 billion per quarter, to in 2024, the last half, essentially per quarter, they were doing about 65. So they doubled it. Those are big numbers. And then, if you drill down a little bit more on the CapEx, you see, Microsoft and Amazon are the ones that their CapEx growth is stalling, at least on a sequential basis. And I think that's really important to look at things sequentially versus year over year, if you want to have this variant view. So, they've grown CapEx, 2.4 times over the, at least Microsoft has, from 6.6 to 16 billion in the last 2 years. But they've kind of indicated the next 2 quarters for them, because they're on a different fiscal year, it'll be flat. Amazon has said a similar thing. They obviously ramped their CapEx close to 100 billion, at least half of that will be, AI cloud focused. But again, they're kind of at that run rate. So it's going to be roughly flattish from here. Now, importantly, within Microsoft, they have indicated that they're going to be spending more on revenue producing in their CapEx, which is more GPUs and CPUs. So there's a positive, mix impact there. And, again, I want to just talk about Microsoft a little bit more, because there's been a lot of noise, not noise, but talk about them being more capital disciplined and reducing their data center leases. And, they're not exclusive with OpenAI anymore. And so that's one of the reasons. There's other people providing some of that capacity. And I've also heard, I think I mentioned this earlier, that Meta had picked up those leases. So it's not necessarily that. It also could have been a little bit of, they just got too much land and that stuff, and they still have the demand, but they were overextended on the land grab originally. So again, looking at the CapEx for the big 4 customers, the last 6 months alone, the CapEx has gone from, call it 230 to 300 billion for just these 4. That's a 30% increase in the last 6 months. And that was all these announcements of, now this is, I'm talking about this is the forward year CapEx. So this is the revision in the expectations. So that's led to lower free cash revisions, but net income has been roughly even. So we'll kind of talk about that as well. So we're talking about, all right, so CapEx has gone up 28%. Stocks are down 4 to 10% over the last 6 months. Hard to know if that's the entire reason. Obviously, there's been some political noise here. But now the management team's like, spend whatever you want as long as your stock's going up. And then they're getting rewarded. But as far as the stock's not working, they're like, all right, stop arms race and spending as much as you can on growth because you're not getting rewarded. So that feedback cycle actually will impact management teams. That is a problem. So that's one of the reasons I think they're going to be more disciplined. People are talking about that with Microsoft. They're one of the more, the catalysts coming up. They've talked about that, or Gil and I talked about the last episode. You can see on YouTube about, Microsoft kind of pre-messaging a little bit more capital discipline going forward. And their stock's been hit the worst. It's down, they're down 10% over the last 6 months. Everyone else is down 4%. So I think the stock price will actually, management teams will react to it. They'll do they tend to do what the market rewards them for. So again, here, just highlighting kind of the big tech, free cash flow, CapEx, and net income revisions last 6 months. What you essentially see is that the CapEx has been revised up by 70, $80 billion. Same time, free cash flow has been revised down by 70 billion, and net income has been relatively steady. So some of that is just the depreciation. There's a whole nother debate out there about should we be depreciating these GPUs over 6 years? They're coming out with new models. What happens to them after 2 years or 3 years? So that is an interesting debate as well. So, at the end of the day, you got to look at free cash more than net income. Now, the other argument is that they're built in data centers, which are much longer. Part of that is longer life. So, and essentially the rent, if you look at the last line here, NVIDIA, NVIDIA is, they're the winner. They're seeing positive free cash flow and net income. They're not really having to spend the CapEx. So all their CapEx is benefiting NVIDIA for now. So that's why they're ramping up their own chips, because they're essentially giving their rent to NVIDIA. NVIDIA is winning right now. And hats off to Jensen for being early on all this stuff on the GPUs and having the best product, and CUDA protecting it, and the networking. The next slide is just kind of, this is kind of where I tie it all together. Just kind of NVIDIA quarter over quarter revenue growth versus top 4 customer CapEx growth. And on the left, you'll see the quarterly number. On the right, you'll see the sum of those 4 quarters. And essentially, the CapEx for the big tech was 29 billion. It grew not grew, but like the quarterly grew by 29 billion in 24. That's only going to be 9 billion in 25. That's the blue line here. And NVIDIA's revenue last year was up by, the quarters were 17 billion. And that's relatively steady in 25 at 19 billion. The problem is, you look at the ratio is 17 over 29 in 24. That's fine. But this year, you're increasing NVIDIA by 19, but the big tech's only up by 9. So you're going to have to find that revenue elsewhere. The mix will help a little bit, or it's just high expectations. And without those customers ramping CapEx, it makes it like a high bar for them to hit numbers. If they're going down when they're beating numbers and raising, I don't know what would happen if one of these quarters they actually don't grow by 4 billion. So so the next slide. All right, so obviously demand's part of the equation too. I've talked a lot about new supply coming online. I've talked about CapEx still growing, but at a slower pace. Demand. There's data points out there that inference could be up 100x. There's all these use cases. Demand is growing fast as well. There's also efficiency out there as well. And it comes down to price. So here we have, a DA Davidson thing where you're seeing the price come down from, call it $3 to $2, for the H100s, the H2s from 375 to 3. And I've seen other data points out there that GPUs were renting for $8, now they're down to $1. And those are, expert network calls, but there is data out there where you can kind of get anecdotes on what's going on in the GPU, at least the rental market. Obviously, some people take the capacity for a long term at a different rate. But to me, this shows you where supply meets demand. There could be new models and new things that OpenAI does or whatever that increase the demand. So it's a constantly changing dynamic. But even with these demands, I didn't see the neoclouds getting good returns, even with these higher pricing. So it seems like more supply, pricing's already under pressure, and demand's a little trickier to measure. Obviously, it's growing and it's strong. I don't deny that. What my only concern is the return on capital for the customers, not the growth in demand. I definitely believe the demand growth is there. So to me, when you start seeing pricing coming down, that to me is the what I call the canary in the coal mine. That there's yellow flag, maybe a red flag, that there's some pricing pressure. All right, so what are the catalysts for the street to kind of realize the view? I would say the first one you're going to look at is obviously earnings reports and revisions. I talked about how NVIDIA stock is going to move with the revisions at the end of the day. That's the most important thing over time. And obviously the customer CapEx, we can now monitor, the for hyperscalers. You can throw in some of Musk companies. You could throw in Oracle. OpenAI is still private, but they did just, get a $40 billion financing from SoftBank, which is obviously positive, and that's, I think, why CoreWeave was up, that in a short squeeze, call it a week ago. So the next one I'm looking at is kind of the Microsoft CapEx. It's already been talked about, being more disciplined, and the mix issue there. So that'll come out in July since their fiscal year is different. Google's still been growing. I mean, they essentially have to win for their own Gemini and Copilot, at least internally, because that's, their search, all the traffic goes to OpenAI. That'd be a problem. Amazon, obviously it's hard to tweak out their CapEx, whether it's for which business, but they have said it's over half, and a lot of it's for OpenAI. AI. And they've had their own chips. They just have to make sure they're competitive on a quality perspective, and they've had some wins in terms of renting out their GPUs. Meta, I think Zuck's going to do what he's going to do. He's going to chase winning and beating Musk. Same with him. They're going to spend. I'm not sure they're as return focused since they kind of control their companies. My guess is they're going to need some money. OpenAI, the private market's still open, still saying they're the best and we're going to fund it. Obviously, $300 billion valuation out there. So as long as they keep getting money in the door, they'll have money to spend. A lot of that money flows through, obviously, places like CoreWeave and then back to NVIDIA. In China, we're already seeing, less GPU demand due to efficiency. We're seeing their own internal supply ramping up. The regulatory issues, that's a wild card. We just got kind of an extension to do business for NVIDIA in China. Then at the end of the day, it all comes down to the supply and demand and the price anecdote. So I'm going to try and keep digging into the rental price and try and get more time series on where the real pricing is. And I think now that we have another public company that can report, they are very termed out, so it's a little different, but getting into that market is going to be important. And overall, I just think the narrative is going to shift from shortages to a little bit of competition, and that's kind of weighing on the multiple. And even the terminal value, you do this DCF, and a lot of the value is in the terminal, but there's a lot of competition, right? They're winning now; they'll probably continue to win, and for a time. But at some point, there'll be new competition when the next chip, and I don't know what it's going to be, whether it's Apple on your phone or quantum. So it's not really something you could capitalize out for 50 years, maybe for 5 or 10. But at the end of the day, it'll come down to kind of earnings revisions. Other things here, I have a DCF here from the professor at NYU. It's like a $78 value. He does use a TAM in there. And that was before he kind of took up his risk premium. I'm always a fan of, he's unbiased, but that's one other tool to look at. The last step in our process is kind of shareholder. Are they aligned? ZMH Advisors did a lot of work here for us and really deep on what's going on with the corporate governance and why are people voting against them. At the end of the day, people love Jensen. He's a founder-led company, product focus, had a lot of success. There are some governance flags, and we've got about 8 slides here. You feel free to go through it. I use ZMH whenever there's like kind of an activist in there. I want to understand things in depth there, but they're one of the leaders in corporate governance, proxies, and activism awareness. So with that, and then the last slide, I guess we're on 48, is kind of go over the checklist on where I think things shook out. But I'm going to get into some questions here. People are asking about other chips out there. There are other chips out there. There's Intel that's cheaper as well. Most of the people I talk to dismiss Intel as a competitor. I haven't really dug into it. I haven't heard too much of that. What's the cost of FinTool? You're going to have to sign up for the trial. I don't actually have that answer for you, but it's been super efficient for me in terms of being able to turn more ideas and be more efficient and not have to kind of go through all these 20 Fs. So do the trial and find out. And I think it'll be worth it. All right. Hyperscalers are designing their own chips and are probably a few years out from full scale development. How does that impact and how you assess future growth estimates for NVIDIA? Well, Google, they're on their 6th edition of the TPU and they are ramping up production. I kind of found that out, I want to say accidentally, but when I was doing the FinTool, research, it popped up there that they're ramping their production. I think it was $6 billion was the number I saw there. And they can use it internally, but once it gets good enough, they can also rent it out to their other customers instead of renting out NVIDIA's chips, or if they don't have enough NVIDIA chips, right? Because NVIDIA gives some to other people. There are still shortages. So I think that will impact, the NVIDIA, this competition, right? Essentially, there's been one game in town for the last couple of years, right? Google and Amazon in Q4 start to rent out their GPUs. So there's more, it will impact them, I believe. And that not only the competition, but also the fact that, that CapEx, it's 75% margin for NVIDIA. So they're going to build their own chips a lot cheaper. Microsoft's still behind and Amazon's been doing it for 10 years, but they are still behind on versus versus NVIDIA. I mean, there are times where I've definitely read where they're faster, more efficient for certain uses. Absolutely. All right, another question. The tech gap between NVIDIA and its comps is the widest it's ever been. So if you're short in, why not short a commodity player in the supply chain where negative revisions will be greater if the cycle slows? That's a great question. Yes. Let's talk about who's a better one. There probably are better, more commoditized ones in the supply chain than NVIDIA. And I just dug into this one first. But yeah, I've had that question before, but it's a great question. And okay, so if it's cyclical and we are at the top, is there a way to tell when the next cycle will begin? This cycle hasn't even peaked yet. So, I mean, I think it has, but there isn't any actual evidence. Usually the stock moves, I would say 6 to 9 months before there's actual evidence in the earnings. So the market kind of anticipates it, which is kind of what's happening now. But when the next one begins, I mean, I have different checklists for different industries. It could be anything from culture and a tangible book or lower margins or an inflection in supply demand, where people are producing less and there's an inflection in demand that you think will overtake supply. So a cycle could come, but yeah, anything times supply or demand, if there's a big spike in the demand that more than absorbs all the supply, yeah, that can cause even a cycle. But it's kind of the market's anticipating a cycle right now. I am, at least. And there hasn't actually been the evidence in the numbers. There's certainly some signposts that could lead you to think that I'm seeing with the competition, but I haven't. You got to wait for the cycle to actually play out before you call the bottom. Using the mental model of long good business for short bad business together with cyclical versus structural model, you can make a lot of the same arguments on names along the chip DC value chain. Thoughts on some of those businesses being potentially better vehicles? Yeah, same question. I don't have any thoughts on other names. I don't like to give out thoughts off the cuff. I like to actually do a lot of work on it to make sure I've checked all the boxes, read the proxies, done the valuation, not to say, this company is worse off for give the 1 or 2 liner. That's, right now I invest in, call 15, 20 names so I can do all of the work and not just kind of invest, this company's worse on this, so I'm going to do that. But yeah, people might do that as well. Yeah. All right. And can you talk about data centers connecting direct to the wellhead and generating their own power? Yeah, I think there's definitely some concern that the grid itself can't supply all the power. It's too much, the regulatory environment to get approved for all that. So people are going to either put up generators and tie into pipes or go right from the wellhead. So yeah, I mean, I haven't dug in too much on the kind of this alternative generation. I know there's a bunch of companies who have recently bought power gen assets to supply data centers on an interim basis before the grid. So yeah, so that's really it, I think, guys. We got couple more here. All right, so NVIDIA has complete dominance on the training market, whereas the inference market appears more open. Do you have any idea as to what % of NVIDIA sales are for inference versus training? I don't have an idea of how much is inference versus training. I have heard that. There was a good YouTube video with Cerberus on how their chips are geared for inference. And I think that's also some of the successes you see with some of the hyperscalers. Internal silica is their chips are geared for specific applications, whereas, sometimes the NVIDIA GPUs are just the workhorse and the best in the industry. Do you think a turnaround is possible in terms of stock price, or has everyone lost confidence in the stock? Thank you. Yeah, I think a turnaround is possible. I mean, as long as if they can continue to hit their numbers and beat, the stock will move with consensus, with revisions. If they can have meaningful revisions upward and keep proving that this is a growth story and it's not a cycle, maybe they'll avoid some of the cyclical multiple contraction and even get credit for their positive earnings revisions. At the end of the day, it's about the revisions. The cycle, you'll see some multiple contraction based on concerns, but they keep growing the earnings. At the end of the day, that's going to be the driver, especially if they do it at a long, return on at a strong return on capital. And then again, there's other things out there. I didn't spend that much time talking about the demand because it's harder to actually quantify. But if there's something else that comes in that gives you a spike in demand and all of a sudden you're super short chips and you see increases in the rental prices, or, right now you just have a lot of capital add in supply. And at the same time, you have things getting more efficient and more competitors coming in. But if the slope of the demand goes up and to the right really fast, there's a breakthrough or something, yeah, the cycle can turn. So yeah, of course it's possible. It's just my view that I tend to think it's cyclical versus secular, but there are a lot of people out there that are saying, hey, it's early innings. they have the best product, and AI is going to be doing a lot more stuff, and you're missing the demand picture here, and everyone's going to use NVIDIA. So there's always two sides to the argument. I just thought I'd kind of present my mental model, the way I think about it. And this is what I'm doing. It's not just me writing a report for the sake of doing it and to get a corporate roadshow or for whatever reason. This is how I invest capital as well. And so I have skin in the game. I heard earlier on the podcast today, no one bats 1,000, right? Just because I've had experience doesn't mean I'm necessarily right on this one or any other one. I do believe I've got a lot of evidence that supports my cyclical view. But of course, I'd love more people to ping me, share more evidence about the bull case. And actually, if you follow Pitch the PM, go to our website, sign up for our newsletter, follow us on YouTube. We're going to be doing another episode where I have a industry player come on and do the bull case. Because I always think it's important to do the bull case and the bear case, and then gather both evidence, understand everyone's bias, crunch your own numbers, and then make your own opinion for your style, for what you believe. Because there's a lot of ways to make money. And again, NVIDIA is now at low 20s PE. It's not at 30, 40 times. So it is somewhat de-risked. There's some of this bad news is priced in. And you're seeing this stuff on CNBC, all the negative news. So as long as they keep beating and raising, at this point, the multiple's not going to probably go down that much. They'll probably get credit for it. Whereas before there was a lot of concern, and that's why the multiple is contracted. So yeah, they can. But and at the end of the day, we still have a short, we're still short, supply. I'm just saying, expectations are pretty high. And at the end of the day, I think stocks move with revisions. And the bar is super high. So it's going to be hard for the stock to work, at least when it was at 30 times PE when I started this thesis, with the bar so high and CapEx kind of growing less than the street would expect the revenues. Big debate if other people come in. But I think that's all the questions, guys. You guys, one more. Are the big numbers thrown out there for data centers possible? There's definitely a lot of money chasing data centers. Possibly anything's possible. The question is, over what period, and do those people want to return on capital, or they're just chasing to build data centers? And what's the return they're going to get? If everyone's building a data center, by the time they come, they're not all going to get the same return that they expected. It's kind of a little bit of a supply glut, potentially, depending on how much demand grows and the efficiency of the current models that make the chips more efficient. Anyway, that's all the questions, everyone. Feel free to kind of ping me anytime. Doug at pitchthepm.com. All right, one more. Is there a large cohort of customers that NVIDIA is funding themselves? Have you dug into that? Yeah, I mean, that's CoreWeave, right? CoreWeave was funded by NVIDIA, right? That worked out great. You put in a couple $100 million. That gets them contracts. Not only that NVIDIA then gave them revenue by using those chips. Then they levered that up with a lot of debt, and then they bought a lot of chips from NVIDIA. So NVIDIA's return is billions of dollars. That the contracts, the debt, the equity they put in comes back to NVIDIA in terms of selling them chips at 75% gross margin. And there's others out there, but yeah, so but also NVIDIA gives them chips when there's short supply. So if a customer wants them, hey, by the way, you got to go here because you can't get the best chips. Yeah, I mean, they created demand and financing. So they increased demand for their product. And, they're selling a product. Other companies do similar things. There's nothing wrong about it. It just kind of creates more competitors for the hyperscalers and all the other. There's a lot of data centers out there besides the 4 hyperscalers. I just focus on them because they're half the base and they're the large ones, but there's many other players out there. All right, guys, I'm gonna sign off here and just say thank you all for taking the time. Sign up for the newsletter, try some FinTool. Let me know how it helps you, and ping me with questions whether you agree or disagree. I'd love to hear it. I just love debating it and talking stocks. It's fun for me, and I value it more when people come with evidence that disagrees with me. It's just it's more helpful. So all right, thank you, everyone.